There's a closing bell on Wall Street, and now it's market domination overtime. We're going to be joined by Jared Blickery in just a moment to get us up to speed on the details from today's session. Let's start with the major averages here. We did see a down day for all three major averages, but not down nearly as much as it was this morning when we first woke up to news that President Trump was sort of ramping up the rhetoric on the EU, talking about imposing new tariffs of 50% there, and taking aim at Apple, talking about 25% tariffs on the iPhone maker on iPhones imported into the U.S. Later in the day, during taking questions from reporters, he also put Samsung in that bucket in terms of phones made by that company. All of that said, perhaps markets not taking it seriously unless he signs somewhere on the dotted line to impose these tariffs. The Dow still finishing the day down, though, by about 256 points, almost a half of 1%. The S&P 500 down about 2/3%, and the NASDAQ composite off by 1%. Jared's got a closer look at the action. Hey, Jared.
Thank you, Julie. If I recall, Monday, we woke up to some bad news that day, too. Managed to claw back the losses. But I'll tell you what, this week has been the worst week for most of the markets we're looking at since the beginning of April. That was Liberation Day week. Here's the NASDAQ down about 2.5%. Not a disaster, but S&P 500 down a little bit more, and the Dow just off about 2.5% as well. I had the VIX on my radar today because it spiked up. It had the biggest spike up in about 6 weeks. It is off of those highs, well off those highs, so it rejected the 25 level, but we are back again we are back over 20, so that's something I'm going to be keeping an eye on. Here's a look at bond market volatility. We only get one quote at the end of the day, and you can see that is ticking down from the high that we had earlier in the week. And let me just show you the 30-year, because that has been a source of contention for the risk markets, potentially. It's been above 5% all week long, and it's drifted up, it's drifted down, but still holding above that big 5% mark. And meanwhile, the U.S. dollar index has slid to the lows of the week. Here's the year to date. You can see it is not at the year's lows, but it's getting pretty close there. So that's another thing we're going to keep an eye on next week, but starting Tuesday, not Monday, because we will be off air for the Memorial Day holiday. Here is the sector action. Utilities, staples, energy, and real estate in the green. So kind of a defensive setup for some of these sectors in the green. Tech, the biggest loser on the day, down over 1%. Here's the weekly totals. Energy and tech down the most. Real estate, discretionary, and financials also underperforming. And let's take a look at the NASDAQ 100 for the week. Google, Alphabet is a standout, up 1.4% in the middle, but Apple down 7.6%. A lot of these stocks, like Tesla, down 3%. A lot of these stocks having their worst week also since Liberation Day. Want to show you what's going on with my leaders, and I'll close out here. Bitcoin is the exception. That risk market has been hitting all-time highs, 110, 111,000. It's backed off of that. But to the downside, chip stocks, home builders, and solar having some pretty bad price action this week, 5 to 10% down. Now, let's throw it back to you, Josh.
Thank you, Jared. We're joined now by Jay Hatfield. He is the CEO of Infrastructure Capital Advisors. InfraCap is an investment management firm with over $2 billion in assets under management, and Jay has worked in the securities and investment world for nearly 3 decades. Jay, always great to see you on set.
Thanks, Josh.
You know, if you were here, Jay, any other day this week, I think we probably would have started on bond and yields. But I think today we start with the man himself, President Trump. He was the one making headlines, dominating the headlines. He's going after Apple. He's going after the EU. But as Julie was saying, the market reaction response was interesting, Jay, in that I know we finished in the red, but off the lows. I'm just curious what you made of it all.
Well, this is pretty normal activity for this time of year. As you pointed out earlier, limited earnings coming out. And good news comes from earnings and bad news comes from everything else, usually. But there's one exception right now, is that you are obviously going to get some good trade news. So what the administration did, because they do care what the markets do, at least Besant does, he came out and said, sometimes at least, he came out and said, oh, we're going to get a deal with India. And also the other thing, we're not relying on this, but the 200-day moving average is just a few points below where we closed, so we bounced pretty hard off that. But so they kind of timed it exactly perfectly. We were bouncing a little bit, and Besant came out. So I think we're saying 5,500 to 6,000 during this second quarter, which is usually bad. The second half is bad, and so it's actually pretty bullish that we didn't just crash on this and that we bounced off that 200-day. So we're pretty constructive, and we do have this unusual situation where Usually you just don't know what's going to happen. It's like, oh, or Moody's and other bad things happen. But we do know there will be some good news on trade over the next, say, 3 weeks or before the end of the quarter.
Will there be bad news before there's good news, though? In other words, if the president comes out and says, right now it's just a post on Truth Social and some talk.
Right.
If we get a 50% tariff on the EU, for example, or if we get a 25% tariff on phones imported into the U.S., what then?
Well, we do think that the whole tariff conversation has been a tariff tantrum, because you're really talking about de facto sales tax on 10% of the U.S. economy.
You know what? I saw that figure in your notes, and I said, come on, Jay. 10% of GDP is imports.
Right.
But it's not 10% of what people spend, right? Of what individuals spend. So one could argue it actually has a bigger effect than just 10% of the U.S.
Well, I think it has a big psychological impact.
And that's not nothing.
In fact, I think there was an article on TikTok, like every time some price moves up by a dime or something, everybody, points to that. So clearly a psychological advantage, disadvantage, and I would say terribly politically. I was here before the election. Betting, we always look at the betting markets, and the probability of the Democrats taking the House rose by 10 points to up to 80% after the tariffs. So it's extremely unpopular. The House and Senate would never do it because they know it's bad for their election. So don't disagree that it's unpopular. It's going to raise a lot of concerns. But economically, even in CPI, like 40% of CPI is shelter, and imports don't really affect housing because it's mostly existing houses. So economically, it's not as important as it seems, and the market's going to treat it.
Jay, let's stick in Washington. House passes Trump's tax bill, the big, beautiful bill. As you try to think through, Jay, what that could mean for the economy, for the markets, what do you tell clients?
First of all, what a great name. It's more entertaining than the IRA. There's very few amusing things in the finance and the economy. But, we're more neutral on it than the bond market was. And we don't even really know what the impact is because they do this CBO scoring, which is kind of swamp scoring. So they take into consideration things that sunset, which we know they never do sunset. And they report the change or the base case being that we let those tax cuts expire. So our estimate is roughly neutral to the deficit. So it's not really a good reason for the bond market to tank. And all those CBO numbers do not show the proceeds from tariffs. So that is budget positive.
How much, can I ask you, Jay, I'm just curious to get your take here. The moves you saw in yields this week, I saw various analysis of that, because some economists were saying, well, I think it's some mix of deficit concerns, I think it's unwinding of recession fears, I think it's what I'm seeing in JGBs, Japanese government bonds, but I'm curious how you see it.
Well, I think during this period, it's not just stock market that gets dislocated. And once you start a momentum sell-off on treasuries, it's usually hard to stop it. And there are people that are absolutely concerned about the deficit and I think misinterpret these reports, it's going to raise the deficit $3 trillion, because it's highly misleading. I've read like 10 articles. I still can't figure out what the real impact is on the current law deficit, which is what we should focus on, right? Because it was never, we shouldn't be shocked that they're not fiscally conservative. We haven't had fiscal conservatism since Bill Clinton was president. So I don't think that's a big shock, but it had an element to it. But we don't think, until the Fed starts to get visibility on cutting, we're going to be stuck in this 4.25 to 450. And I'd say the same thing about the bond market. It was pretty resilient when we got over 450. And the problem with being over 450 is that the 30-year mortgage goes well over 7. And 11 out of 12 post-World War recessions were caused by the housing sector. Now, it is very resilient. We had good housing data this morning. But that's something to watch. Below 1.1 million usually have a recession. So that's, though, what we think keeps a lid on rates. But in the short run, people get nervous about Moody's, about the budget deficit. But ultimately, we think Fed policy is going to drive rates lower.
Jay, I got one more question for you when it comes to the interplay between rates and stocks. Because I saw a good chart today from Julian Emanuel over at Evercore ISI, where he looked at the last few years. He's looking from October 2022, and this is a look at what stocks do when the 10-year yield is below 4.5%. In a word, they like it. Stocks do better when yields over the past 3 years or so have been below 4.5%. So if they're hovering at that level or above it, is it going to be tough for stocks to gain more traction?
I think so. We look at it more theoretically. And so we have a 6,600 target on the S&P, which, by the way, is down because there is no corporate tax cut. So we were assuming it didn't happen. So we do adjust our targets for that. But the 6,600 assumes the 375 Treasury. And every 25 basis points, if you do a DCF, it's somewhat theoretical, is an S&P multiple, which doesn't sound like a lot, but that's 3 S&P multiples. And the estimate for next year is 300, so that's 900 S&P points. So that's how we would get to the same conclusion using different data, is that it does matter where rates are from at least from a target multiple. Like 22 is okay if rates are at 375. It's probably not going to be sustainable if we're at 4.5 or 4.25. So our bullishness, we have to be right about the Fed and inflation, but we think that we have an advantage relative to the Fed because we look at the money supply and they don't, which is crazy in our view. So, but we do have to be right about that.
Right. Well, we'll see. We are. All right, Jay,
Great.
thanks so much. Good to see you. As we've been talking about, the bond market has been flashing warning signs once again. For more, we're bringing in senior reporter Ali Canal with the Yahoo Finance Investor Playbook.
Long-term Treasury yields surging this week, driven by growing fears over America's mounting debt crisis. The 30-year yield spiking as high as 5.15%, the biggest single-day jump since 2023, and flirting with levels not seen since 2007. Wall Street experts say the recent move to the upside is a warning sign that investors are demanding higher returns to offset growing fiscal risks. And at the center of it all is President Trump's newly advanced tax bill, which just passed the House. The bill proposes sweeping cuts to personal and corporate tax rates, but it's also projected to add $4 trillion to the national debt over the next decade. Despite its size, the bill offers little in the way of immediate spending cuts, something that's further spooking markets. Here's more of what Wall Street watchers told us this week.
What's making things worse is that we have an unsustainable fiscal situation that is leading to very challenging dynamics in the bond markets, where we're having to pay higher interest rates to service our debts.
Long end of the curve, there's a tremendous amount of uncertainty, and we're starting to see investors get a little spooked.
Listen, there is not good news here. Congress has the ability to reverse course. They have the ability to not pass this legislation, and that would be really good for the economy. And I think that's what the bond market is saying right now. Whoa, let's not go down this path.
Now, sources tell me that while the U.S. deficit appears to be the main driver of this bond market volatility, it's not the only factor. We're also seeing cracks in demand. A weak Treasury auction earlier this week raised some eyebrows. And over in Japan, a deepening fiscal crisis there is sparking fresh fears that global bond market stress could bleed into U.S. markets as well. So a lot to keep track of over the coming days. And we'll be watching closely as this tax bill moves to the Senate. I'm sure, especially if this week was any indication, Wall Street will be reacting.
Thanks, Ali. Appreciate it. Coming up, NVIDIA will be top of mind for investors next week, but that won't be the only thing affecting your portfolio. On the other side of the break, we'll tell you everything you need to know ahead of the holiday shortened week. Stay tuned. More market domination overtime coming up.
Well, it's likely President Donald Trump will get that big, beautiful tax bill he is looking for, but markets haven't really celebrated as the president may have hoped for. Yahoo Finance's Rick Newman joins us now with this week's rendition of Trump-O-nomics. Rick.
Hey, guys. Trump is on his way to getting this bill. I mean, I think the hardest step was getting the tax bill through the House, where there were the most divisions and the most difficulty getting Republicans to pass it with that narrow majority they have. So there are going to be some changes in the Senate, but most of the betting is that there will be a signed bill by let's call it late summer. Trump should be celebrating this as a big win. Markets generally like lower taxes, but that's not what the narrative is in the market this week at all. Obviously, as you guys have been discussing, the big question is what's happening in the bond market. And the bond market is just simply unhappy with what's happening in the Trump economy for reasons that you guys have been talking about. There's too much federal borrowing. This tax bill is just going to add to that. We've got new questions about whether Treasury securities are going to remain a safe haven investment during times of trouble. That has not so much been the case lately. So this seems like something that could be a pretty unwelcome cloud over Trump's first year in office. And at some point, the national debt, which is more than $36 trillion right now, this is going to be unsustainable. And, you know, is the debt crisis here? Maybe this is it. Maybe the house is not going to come crashing down all at once. Maybe it starts with cracks in the foundation, leakage, and then things start to get shakier. But we may be at the debt crisis, and this is going to be more important for Trump to handle. And I'm not aware that he has any playbook for it at all.
On that happy note, Rick, have a great weekend.
You too, guys. See ya.
Time now for what to watch next week. A lot of earnings on deck next week, but all eyes, of course, they are on NVIDIA. The AI juggernaut announcing results for the first quarter after the markets close on Wednesday. Analysts expecting NVIDIA to post strong Q1 results driven by high demand for its new Blackwell chips. Yahoo Finance is covering all things NVIDIA on Wednesday with special coverage starting at 4:15 p.m. Eastern.
Taking a look at the Federal Reserve, Fed Chair Jerome Powell speaking at Princeton University on Sunday. This comes after comments earlier today from Fed President Alberto Musalem. He said that the Federal Reserve must contain long-term inflation expectations with businesses and consumers anticipating rising prices in the near term.
And finally, we're going to be getting some fresh inflation data to finish off the week with PCE on Friday. That's personal consumption expenditures. Economists forecasting both total and core PCE to tick up to 0.1% on a month-over-month basis.
NVIDIA gearing up to report first quarter fiscal year 2026 results after the market close on May 28th. The highly anticipated earnings announcement will come as the stock has seen a volatile run so far this year. The chipmaker has faced several setbacks, ranging from China trade restrictions on its chips to concerns relating to expected semiconductor tariffs, but major investment announcements tied to the Middle East and Washington's planned AI diffusion rule helping give the boost to the company's share price. NVIDIA also recently making a flurry of announcements showing off new technologies at the Computex Taipei Tech Expo in Taiwan. Here's what analysts had to say on what all of this means for the chipmaker.
You know, there's some near-term worries just because of the China bans. You know, they were banned from selling this H20 part in China, which is meaningful. I think I saw an article just today that said Jensen had kind of sized it, you know, potentially $15 billion. And, you know, that's kind of in line with what we had thought. And, you know, I think they're supposedly trying to work around some of the new constraints. And so it's very possible that some of that revenue comes back. But I mean, does it impact in Q2? It very clearly might. I don't think that'd be a shock at this point. I think that's anticipated. But I think some of the noise around China near term is certainly a concern and a question. I think there's also some of the supply chain stuff. This Blackwell transition has been challenging. It does look like they're in production. Jensen made some comments on that last night. But the ramp of Blackwell, like into the end of the year and into next year, I think will be a question. And then clearly, as this stuff from the Middle East and maybe from other places starts to ramp over the next several years, like how can that contribute? You know, investors have been worried that 2025 could be a local peak for CapEx. And I would say the only ones that have really been worried about that are investors. Like the companies that are actually spending the money don't seem to be worried. CapEx budgets have actually been going up, not down. But to the extent that investors can get confident there's still more growth to be had as we go forward, I think that's for the long-term thesis. I think that's what's most important.
Of course, you could say you want everyone all in on NVIDIA. I'm here at Dell Technologies World, and I guarantee we're going to see more all in on NVIDIA. But realistically, that's just not how enterprises and how hyperscalers build. We know that the large hyperscalers are building some of their own custom compute, but they're also building with NVIDIA. Why not open that up so these companies can go big, but still benefit from where NVIDIA is leading? And that's in many areas, including how fast they can connect these machines to one another to deal with this massive volume of data. As we move to these agentic systems, which we are in the earliest days, and then of course, as we do connect the physical world, we're going to need so much compute, so much energy, so much efficiency, and so many tokens that I think trying to close the garden off entirely is probably a risk. And Jensen right now is playing his cards really well, whether it's how he's dealing with the politics of China and the Middle East, or how he's handling kind of opening up just a little bit to make sure that NVIDIA investors have a way to grow, even if not everything is NVIDIA silicon.
And they are the key AI stock, and they got as high as 150 in April. They bottomed in the a little bit below 90, so huge volatility. And it started after DeepSeek, the big news in the China AI, would you need a lot less chips to really commoditize AI usage? That was a big 20% down in a day, and it's rallied back. You look at the data center demand, it's not going away. Everybody talks about, I've seen some stats that data center demand is growing 50% a year. And so now the question is, can you just do so much more with their chips? And the technology is exciting. I think your early days of AI, people using it, getting applications built on top of it. So there's an element of where we're just starting. Google just released AI mode last night, so they're just starting to have new applications of this. And so, you could see a lot of continued runway, but the question is, will we get a technology that lets us use a lot less NVIDIA chips is the holy grail question that we'll see over the next few years.
Now, taking a look at the near term, the question investors are looking to have answered is if CEO Jensen Huang has played his cards right to deliver on first quarter results. Here's what Wall Street is expecting heading into NVIDIA's financial results.
Very likely they're going to at least meet to maybe overachieve on the earnings estimates because that longer term secular theme of earnings growth remains intact. I think for the rest of the market, things like tariffs, slower growth, some of the cyclical areas that are exposed to technology, those are the areas that are going to likely have to prove that their valuations are warranted right now, particularly if the economy slows in the second half.
NVIDIA needs to say that its chips are in demand and that there are no other competitors currently. Because everybody, if you make a semi, wants to replace NVIDIA as the preferred chip. So those are the two comforting messages that NVIDIA has to say. And I love momentum investing when it's working. But here's what the problem is. The top buyers of NVIDIA are playing this game that they are going to continue investing at the same rate their competition is, because the minute one of them takes their foot off the gas pedal, they're going to become irrelevant. Not just lose first place, we're talking irrelevancy.
But once NVIDIA's first quarter results drop, what should investors expect from the stock after the report? Here's what the options market is signaling.
First, the big picture. Historically, NVIDIA's stock reaction is a mixed bag, but leaning bullish immediately after earnings with median gains of just 2 to 4% over the first month. But then watch out, the stock tends to blast off, about 18% historical gains by the end of the quarter and a whopping 117% return 1 year later. And the longer you the longer you hold, the better your odds. A positive outcome happens about 83% of the time after 1 year. Now let's zero in on the AI area. This is the past 10 reports, so artificial intelligence has been the name of the game, stretching back 2.5 years. The stock's next day pop has averaged nearly 12%, but the options market is only pricing in a 7.4% move after the report. That means traders might be underestimating the impact of NVIDIA's earnings. But outside of earnings, NVIDIA's typical daily move is only about 4.5%. This means earnings days are 2 to 3 times as volatile, and here is the scorecard. 6 big wins with an average gain of 11% over the last 10 reports against 4 losses with average dips of about 5%. Basically a coin flip, but the wins have paid much bigger than the losses. And if you're a long-term holder, here's your rolling gauge. NVIDIA's 1 year returns measured from each earnings date are currently at all-time highs. Multiple years have posted gains over 100%, with only brief dips below zero since 2010. Momentum clearly favors patient holders, but this number has dipped below zero before, so there are no guarantees. And the bottom line for traders, expect wild short-term swings, but over the long run, NVIDIA's trajectory has tended to be up. And here's a pro tip. Given history, options might actually be cheap here, so volatility buyers take notice. Well, NVIDIA's report, will it extend this incredible streak or will it break the trend? Stay tuned.
Indeed, investors will have to stay tuned for how earnings play out for NVIDIA. And to watch it all unfold, be sure to tune into Yahoo Finance's special coverage of NVIDIA's first quarter results. That's on May 28th at 4:15 p.m. Eastern Time. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.